Hi, everybody. Thanks for joining us. I'm Chad Smith, and I'm joined by Stephen Weitzel. We're going to talk today about recent action in the market that we think reflects a potential change in the market dynamic. So, Stephen, we've been talking about this unique environment for the last several months, and in particular, the extremes that have been developing in the market environment, where U.S. large cap stocks, in particular large cap tech stocks, and even in more, kind of a more pronounced way, these AI names that have become so dominant have been really leading the charge and been the prominent drivers of market returns for the last several months.
Yes.
And we highlighted recently in a series of videos how that had gotten to an extreme level, historic extreme level. And we have been looking for a change in that market characteristic, and in particular, an environment where the rest of everything else, many other asset classes within equities, but also even outside of the stock market, begin to catch up in this rotation into the other things in the market. And we've been seeing some signs of that over the last several months that have been constructive. We've talked about that in our monthly videos and a few other publications.
Yep.
But there's been some unique action in the last week or so that suggests that maybe that time has come where this pronounced rotation begins.
Yeah, and so the fundamental idea is that in the long term, valuations matter to returns for investments, and that when you have areas of the market that are very expensive, that the forward returns in those areas historically are below average when you get to extremes like we're experiencing in these areas today. Oftentimes over 5-10 year periods of time, the forward returns of those areas at those extreme valuations are often below zero. And so we had been advocating for clients broadening out, further diversifying, looking for opportunities in areas that had been overlooked, and not get caught up in the FOMO, the fear of missing out and chasing those hot trades. I referenced it in the white paper that I wrote, Don't.
Right.
But this historic outperformance that we'd seen from technology relative to basically every other area of the market, we knew that it eventually would come to an end. And not that we make forecasts here necessarily that we're beholden to, but I find it very interesting that level of outperformance from the technology sector, the NASDAQ, it really ceased in earnest when we got that June CPI report last week. We saw a big shift.
Absolutely, yeah, that was the catalyst, it seems to be. And on that particular day, the CPI print was lighter than expected.
It was negative.
Good news, yeah.
It was negative, which is good news for consumers, but negative for the first time since the pandemic.
Sure, right. And that sets the stage for a change in market perception regarding the direction of interest rates and the prevailing policy that maybe is necessary now by the Fed. And so that shift in inflation expectations and the outlook for interest rates really seemingly was the catalyst to cause investor behavior to change. And in particular, on that day, we saw this pronounced outperformance from small cap stocks. And yet, on a day in which those large cap tech names actually fell, we saw small cap stocks as measured by the Russell 2000 increase considerably for that day.
That's right. And so, a lot of the big investment banks had been putting out some range of expectations for the way they saw the markets behaving based on what that CPI print came out at. And their expectation was that if inflation came in much lighter than expected, that it would be a very strong day for the stock market. But ironically, if you just looked at the NASDAQ or the S&P 500, the NASDAQ was down over 2% that day. The S&P 500 was down close to 1%. And so a cursory glance at those two indexes would make you think that maybe it wasn't a great day for the market.
Right.
but the equally weighted S&P 500 index was up over 1%. The small cap index, the Russell 2000, was up over 3.5% on that day. And so there have been very few instances historically where we've seen the Russell 2000 outperform the NASDAQ by over 5% in a single session. And the most recent times that we have, a lot of them clustered around the peak of the tech bubble in 2000. And so it's ironic when we look at the chart, we can put it up where we look at the historical performance between the NASDAQ and the Russell 2000 index, that this the apex of the outperformance of technology in this sharp reversal, it's happening from the same level.
Yeah, that's right. So we go back and compare to the previous time when we were at these levels of extreme outperformance and arguably extreme relative valuation. Go back to the internet bubble bursting in 2000, and that
That's right.
that occurred then. Another thing that's been unique, and we think been setting the stage for this reversal, has been the very unique nature of the market leadership recently, which has been the concentration, the degree to which there only are a few or a handful of names of the largest cap stocks that have led the charge. And we recently pointed this out in our monthly video. We can show it again here, but the percentage of stocks in the S&P that have outperformed the S&P 500 of late.
It's at a record low.
Record low in the last 50 years. And what that really, we have been saying is it points to a potential risk for the market, and then also potential for this potential cycle change and shift in.
That's right. So it's both this market right now is both fraught with risk and it's ripe for opportunity. That investors that have continued to crowd into the things that had been working are likely to be disappointed. But if they've diversified into the other areas that had not been working, and sometimes being diversified, remaining diversified, it takes a lot of discipline to do that. But that's where the areas of opportunity are. The valuations in those areas are much more attractive and are supportive of better long-term results. And so our thesis has been that there should be a broadening out. So this market is fraught with risk. It's ripe for opportunity. And it does appear for now that the catalyst for this rotation into those areas is that the Fed policy is likely to be able to shift. Because as the inflation numbers continued to come in above forecast for a number of months, the likelihood that the Fed was going to be able to cut had been continued to push out. But now all of a sudden there's almost general consensus now that we're going to start to see rate cuts in September and likely another one in November after the election. So the companies that had been most hurt or felt the most pinch of these higher rates are likely these small cap companies. That's why they haven't gone anywhere for the last 3 years. But you take that headwind away now, they start to get some relief from lower interest rates, and they've got a lot of catching up to do.
Yeah, that's right. And then I guess the last point we'll touch on is this recent action in the market, whether it is the actual turning point that we've been looking for. We don't know yet, but what we do know, we have a lot of confidence in, is as we look out on the horizon.
Sure.
We know that, and we'll bring a chart up here that illustrates this that we've displayed before, is if you look at the current level of valuations, to your point earlier, of various asset classes in the market, and historically what those levels of valuations has translated into future subsequent returns. We can't project. We're not in that business of trying to make predictions, and we're not going to make hard and fast forecasts. What we can draw are conclusions regarding the historical correlation between relative valuations and subsequent returns. And what we know is those areas that everybody's been so focused on piling into, and that have been the narrow leaders in the market, have those relatively historically higher valuations.
Yep.
and all the other things in the market that people are not necessarily diversified into, that we're promoting to consider diversifying into, have more attractive valuations, and therefore historically, have tended to have better returns in the future. So our expectation is that may unfold in the future, but it reiterates the point of the importance of diversification.
That's right. And so just a couple of things we can point out on that chart from Research Affiliates that will show is that the areas that have performed the worst over the last 3 years, 5 years, are the areas that they have in their capital market assumptions that have the best prospects going forward. And the areas that have performed the best, that everybody's wanting to crowd into right now, U.S. large cap growth, are the lowest on their radar. And both of those, they actually, in their capital market assumptions, are assuming that they will underperform even cash over the next 10 years. And that is something that most investors, they can't fathom.
Right.
They are not positioned for. Most of them are not going to change that probably until it's too late.
Yep.
And so, again, we're trying to be proactive on this, make sure that our clients remain diversified, that they're able to take advantage of opportunities that are in front of them right now.
That's right. That's great. Well, we appreciate you joining us. So if you'd like more information on the outlook that we have and how we're navigating the market environment, especially utilizing our rules-based investment discipline, we would love to speak with you. Please reach out to us at info@reveillewealth.com. Thanks much.
Thank you.